Hi there, my name is Matt Swatton and I'm a director with Canaccord Genuity Wealth Management. This video is for those of you who are fortunate enough to have already retired. I'm going to talk a little bit about what it might mean in terms of investing. Before I start talking about the process of what you might do with your money, I think it's important to think firstly more generally around what retirement really means. Think carefully about your objectives. The key question I've had is, why would you need to invest in the first place? Is it because you want to help your children get on the property ladder? Is it because you want money for long-term care when you enter later retirement? Or, more commonly, are you trying to generate an income now to support your standard of living? It's important to take the time to think through those objectives. Think about what you're trying to achieve before you start. For an investor that's no longer working, investing can feel a bit like a tightrope. During your working life, you probably had a guaranteed income. You were able to put money aside, save money, perhaps even take additional risk with that money by investing it, knowing that every month you're going to get another paycheck, either through employment or self-employment. And that will give you reassurance because it means that you feel more comfortable taking risk. You know that next month there's always going to be another payment hitting that bank account. If you're investing in retirement, however, that machine that paid out money every month is no longer there. And you quite often find that people that are retired are reliant on their accrued wealth to provide them with their standard of living. So coming back to that idea of a tightrope, what do I mean? Well, consider this. Perhaps you're in a position where, due to no longer having that guaranteed income, you want to take less risk with your money. But at the same time, you feel you need to protect your money against inflation, potentially even grow that money. Now, to do that, you have to take risk. So those two objectives don't sit comfortably together. Trying to find some way of ensuring those two seemingly opposed needs are met can be pretty challenging. When I meet a new retired client for the first time, the first thing I'm going to do actually is create a financial plan. Essentially, this is a forecast which considers your current financial position, guaranteed income, investments, fixed assets, expenditure and liabilities, and then projects forward into the future a number of different scenarios. For example, what if I spend more of my savings? What if we have an economic shock that impacts investments? What if I need to support myself in later life and I need care? What if I give money to my children? By doing this, we can look at the viability of any of the financial decisions we make today on your finances tomorrow. Personally, I think it's a fundamental document, the cornerstone by which everything else that I do flows. Without it, it's really hard to come up with an investment strategy. What investment approach should you take? Whether should you invest or not? How much risk to take and how long do you invest for? All those things become much harder to quantify. So I would say, take some time to think about your current financial position as well. It may need be that your needs can be partially or even fully offset by guaranteed income that you're already in receipt of. Maybe you're fortunate enough to have a final salary pension or you're receiving the state pension. If this is the case, then you'll probably have more flexibility with your invested assets, as that guarantee will provide you with something of a safety net. However, let's assume that you do have a need to generate income from your investments, as this tends to be the main priority for most retired clients who come to see us. How you generate that income probably depends on how the money is invested. Well, let's think about how most people have their money invested in retirement. So for starters, let's assume you currently have your money tied up in a pension. It's likely that if you set that pension income up within the last 10 to 15 years, it's probably going to be in something called a drawdown arrangement. That means that you are now in a position where you're drawing an income directly from pension funds. The benefit of doing this, of course, is that you have retained flexibility. You've got a pension fund that's still yours, it's got an underlying value, and you decide how much income you want to take from it each year. You're also able to vary the timing of that income, so it's a pretty flexible arrangement. It also means that upon your death, there's a lump sum that potentially can be passed down to loved ones, maybe a spouse or children. And also for UK residents, it comes with some inheritance tax benefits, as UK pension funds are passed free of inheritance tax. However, nothing is ever straightforward in the world of financial planning, and by having your pension set up in this way, it's quite possible that every year your pension is sat on the tightrope we spoke about earlier. It's that balance between generating a reasonable return and being exposed to investment risk. Recently, over this autumn, another option is now reappearing on the horizon, which may, in some instances, be worth considering for some investors. In the last few months during 2022, we've seen something in the world. We've seen interest rates rise considerably, and that means, for the first time in over a decade, the viability of an annuity for more retirees has come back onto the radar. I personally don't think this is something that can be ignored. If you're invested in a pension in drawdown at the moment, this is something you're going to want to consider. Especially, actually, thinking about it, if you're a low-risk investor and the primary reason for your pension being there is to provide you with an income. For the first time in quite some time, revisiting the option of an annuity and getting some advice around whether or not an annuity is appropriate is going to be more relevant. The rate that you receive on an annuity is linked to interest rates and gilt rates, both of which have been on the rise considerably over the last few months. That has already started to feed through to how much you could receive. Just as a reminder, setting up an annuity is essentially a process whereby you give up the value of your investments and give them to an annuity provider. That provider is then willing to provide you with a guaranteed income for life. You can decide to have that rising with inflation if you'd like. You can also ensure that there's a guaranteed period so that it can continue to pay for a period after death and pay to loved ones. You can also ensure that it has a spouse's benefit so that it will pay a regular income to your spouse upon your death. So the key benefit of an annuity is that it's giving you a guaranteed income for life. It takes all the risk off the table. The downside of an annuity, of course, is that you're essentially gambling with how long you're going to live. You also give up the flexible benefits of drawdown as well as the fund value. You might get better value by keeping the funds invested and taking on that investment risk. Let me think about it. Let's think about an example. If you take that annuity out and it's a simple annuity without any guarantees attached to it and you die 12 months, 18 months, 2 years later, you've given up all that pension value and ensured the annuity provider walks away with all that money. Over the last 10 years, it's been really hard to find an argument for a lot of clients. Not all clients, but a lot of clients for that to be an appropriate solution. Now, however, I think it's definitely coming back on the agenda. So one of the first things you might want to think about with your retirement fund, certainly if it's in a pension, is whether or not an annuity is now appropriate, based on the fact that things have moved on, and it may be sensible to have a review of your overall affairs. If, however, an annuity isn't appropriate, maybe you're in a position where actually that guaranteed income isn't the primary reason for the pension being there. Maybe you're in a position where you have a pension that's actually a bonus. It's on top of other income that you're receiving during retirement. Or maybe it's likely your pension's going to pass down to people when you die, and you need more flexibility around your income. Then drawdown might well still be appropriate. Leaving pensions to one side for a second, let's think about income generation more generally. This would apply to pension drawdown, but it also applies to those of you with invested portfolios and investment ISAs as well. Let's imagine for a second that you have a pot of money and it's invested, which I'm sure many of you do. This means the value of it will rise and fall with the markets. The degree to which it rises and falls, of course, depends on how much you invest and how much risk you take, but nonetheless, the return is variable. Now let's imagine that you're drawing money out of that portfolio on a monthly or annual basis. That could be through regular withdrawals, drawdown, or just taking natural income. That's income from dividends or generated interest. It doesn't matter how, but you're taking money out of a portfolio in some way. The first thing I think then is to consider how often are you reviewing that income. Personally, I think it's important that it gets reviewed regularly. It's vital actually because those withdrawals impact performance. Think about the current market conditions. We're going through a period of real economic turbulence. That will continue to drive markets lower at the moment, and that means the value of people's portfolios over the period of turbulence will fall as well. During a period like that, where things are quite unpredictable and you continue to withdraw an income, essentially what you're going to do is exacerbate the fall. That's inevitable because you're drawing money out while it falls in value, and therefore that fall is going to be deeper. Also, when there is a bounce back at some point, who knows when, but hopefully at some point in the future, the thing to consider is that bounce back is also going to take longer. So the quantum of your withdrawal, how much you take out on an annual basis during a time of uncertainty is absolutely fundamental. At this point in time, what I'm doing is revisiting every single client who is taking an income from their portfolio and looking again at how much they're taking as a percentage of their overall asset base. Looking at its sustainability, looking at the long-term implication of that withdrawal over time. Obviously, with the current crisis, an increase in the cost of living, issues with high inflation, there's a question around whether actually reducing income levels is even doable. But if it is, and we have the flexibility to do so during a time like this, I think is a top priority. Take advice if you're not sure how much income you should be taking from your portfolio. So, let's assume we know how much income you need, if any, and why you want to invest. Well, the next step that's going to be really important to structuring any sort of investment solution is qualifying your attitude to risk. And really, there are three ways to think about risk. The first is your natural tolerance for loss. That's how you feel about risk in your gut. If someone is naturally cautious and therefore finds it difficult to deal with high volatility, we would expect, as a starting point, for their portfolio to probably reflect that. It might mean more money in lower risk investments, such as gilts or bonds, and less money in growth investments like equities, where the downside risk is higher. However, just thinking about how you feel about risk, I don't think really goes far enough in terms of quantifying how much risk you should or shouldn't take. Maybe that same cautious investor needs to take an income, and in order for his money to be protected against inflation, he has to grow his funds by more than he would naturally choose. This is a definition of your need to take risk. In other words, how much return do you need to achieve your stated objective? And then the final way to think about risk is your capacity for loss. If you're invested and there's some sort of economic shock, how is that going to affect your retirement plan? Are you still going to be able to support yourself? As I've mentioned, we're in a period of time where the economy is getting hit quite hard. Let's imagine with that as the backdrop that your portfolio falls significantly. Do you have the capacity in your finances to recover from that fall? So how do we assess risk? Well, your tolerance to risk is actually quite simple. We can get some sort of an idea by meeting up, talking about risk more generally, in combination with some sort of risk questionnaire to create a picture of your view around risk. The other two, your need to take risk and your capacity for loss, are more quantitative, and we can come to an agreement on those by falling back on careful cash flow modelling and financial planning. This means looking at two things. Firstly, the long-term impact of a variety of different returns on your money, and secondly, the effect of a significant fall in the value of your portfolio on your standard of living. So I think having a very detailed, considered and sensible conversation about risk is an absolute fundamental when you're in retirement. And again, it's something you're going to have to review quite regularly because as you get older, your needs and the way in which you run your life will inevitably change. Talking about how things change during retirement actually brings me on to another really important point, which is thinking about the future. If you're in early retirement, or even in mid-retirement perhaps, thinking about later retirement is something that would be pretty sensible. For example, what if you need care provision in later life? The cost of care in the UK is very, very high. To fund a decent level of care in a residential home can cost £1,500 a week or more, and if you're in a financial position where you have enough, it's sensible perhaps to put some of your money aside so it's there to provide you with a backstop and some sort of financial protection if ever you need it in the future. So finally, let's imagine that all of your needs are met. You have enough to support you in retirement. You've set aside a lump to provide for later retirement and care cost, and you have a sum put aside in case of emergencies. And even after all of that, you still have funds left over. It might then that you're looking to create a legacy for your children or grandchildren. Now, that brings us into the realm of inheritance tax, and I could do a whole other video on inheritance tax and estate planning. But all I will say today is that the way in which money is structured, gifted and protected is a complex area which I'd strongly recommend that you receive good financial advice on. It's likely that the way in which legacy funds are managed will also be somewhat different to your own, and so taking advice on the management of those investments is also advisable. Hopefully you can start to see that often your money in retirement is split out into different objectives. For now, money for the next few years, money to generate a long-term income, and also perhaps even longer-term money to provide you with some protection against care provision. If all of that's covered off, there might also be a pot which isn't for you, but instead is managed for the benefit of others, children or grandchildren maybe. So how much would you need to put aside for all of these objectives? Well, that would need to be calculated and considered, and you do that through careful planning. It would mean gathering all of an individual client's financial details and using that to create a forecast for the future. Once we have an idea of what the future might look like, we can think about how much to put in each of those pots. How much to have in that pot for money now, how much to have for income, how much to have for retirement, and how much to have in case the worst happens to you. And if through that process we find you have more than you need and you're in the fortunate position of having additional wealth that you can't foresee needing, it may be that we then have a conversation around inheritance tax. How do we ensure that you create a legacy for your family and your bloodline and that the value of those assets are passed down? All of this is going to impact how your money is invested. It might take into account how your loved ones would react when you die and what they might do with your money. Would your loved ones continue to invest, or would they want to pay off things like mortgages? There are lots and lots and lots of different points to consider and potential avenues to take before you set up or review a portfolio. So I guess my closing statement would be you need to think first and foremost about your individual situation. What are your objectives and how would you order them in terms of importance? No two client situations are the same, and as such, no two solutions should be the same either. Take advice where appropriate and ensure that all your funds are well managed in line with your expectation and need. I hope that's been of some use. I've been Matt Swatton. Thanks for watching, and if you need any more assistance, please don't hesitate to get in touch.